Bankruptcy.
A stunning fall.
Major restructuring. Debt is piling up.
It's fair to say that last week has been a tumultuous one for US regional banks. Across both banks, several factors have been blamed for their liquidation.
Based on data from US courts, bankruptcies are affecting US businesses and average American people very severely in 2024. While businesses are suffering from declining earnings and declining sales at a time when costs are rising, higher consumer prices are forcing Americans to take on enormous debt in order to make ends meet. Big banks are tightening lending rules in an effort to stop further losses and defaults in the coming months, as the credit crisis is now at levels last seen during the Great Recession. In fact, for the first time since 2010, the Federal Reserve System's Board of Governors announced that bank credit levels have decreased for 3 consecutive quarters. In more than 50 years, this drop is the only one of its kind. The last one was observed in 2008 and 2009, when the world was still struggling to deal with the effects of the global financial crisis. The prolonged decline in bank lending coincides with a persistently gloomy forecast for the U.S. economy from many Wall Street economists. Thilo Moratz emphasized that bank credit is declining for the second time in 50 years. Head of the German insurance company, Continentale Versicherungsverbund's liquid assets. According to him, credit contraction would force businesses and consumers to borrow less money at higher interest rates, which would increase the cost of borrowing money. Economic growth may be further hampered when it becomes more difficult for firms to borrow money, and consumers are compelled to postpone major purchases like homes and cars. Interest rates at all-time highs merely exacerbate the assault. Nevertheless, the central bank has made it clear that it won't begin easing monetary policy until it meets its 2% objective. Experts predict that until then, it will be more difficult for consumers and enterprises to obtain loans. The majority of U.S. banks tightened their lending requirements over the previous quarter, according to data from the Federal Reserve Senior Loan Officer Opinion Survey, which was released late last month. Businesses saw a 51% increase in bank lending standards for commercial and industrial loans to middle-class and large businesses, and a 68% increase in lending standards for loans pertaining to commercial real estate. Bank holdings of commercial real estate loans have decreased by $33 billion since February as a result of increased rates of delinquency and heightened exposure to the sector's ongoing crisis. Over the course of the past year, 5 financial institutions holding billions of dollars worth of commercial real estate loans have failed, including Republic First Bank, which was taken over by authorities and sold to a competitor last month. Residential mortgages were still being squeezed by credit restrictions when it came to lending to the household sector. However, throughout the first 3 months of 2024, the demand for loans was restrained due to rising mortgage rates. Despite banks' diminished willingness to lend, demand for consumer loans, which include credit card, auto, and personal loans, kept rising. The Fed study also indicated that 36% of U.S. banks raised their requirements for consumer credit cards from 30% at the end of 2023 to more stringent requirements now. The newest data have fallen into an area associated with earlier recessions in the U.S. as an illustration. In the first quarter of 2008, banks tightened conditions for 32% of commercial and industrial loans to U.S. enterprises. In the same period in 2001, the percentage was 51%. A few bankers have blamed declining deposits for the problem. They question, how can we make loans without deposits? They do have a point, though. The total amount of bank deposits has decreased by an astounding $313 billion in the last 12 months. But this statistic underrepresents the amount of suffering that American financial institutions are experiencing. Core deposits, total deposits less big certificates of deposit, have decreased by $1 trillion in the last 12 months. And this is not even the worst of reality. The balances of money market deposit accounts and checking accounts have also decreased. The length of the economic downturn is another significant issue that puts additional strain on bank executives who establish lending standards. According to a Wall Street Journal study, 63% of financial professionals and economists believe the current economic downturn will last for at least a year. It makes sense that bankers are concerned that other banks might fail in 2024's second half. The situation is made worse by the fact that large U.S. banks are suffering substantial losses this year as a result of both personal and business bankruptcies. According to data from U.S. courts, the number of corporate bankruptcies increased by 40% in April over the same period last year. In the meantime, there was a 16% increase in personal bankruptcies, accounting for about 434,000 filings annually. Experts claim that the astounding figure is a sign of the times. High interest rates, credit card minimum payments, and the expiration of the student loan payment deferral, according to Philadelphia bankruptcy attorney Michael Schwartz, created significant financial hardships for Americans. Families' expenses have increased dramatically as a result of these issues, and many are turning to bankruptcy as a last resort, Schwartz told Newsweek. The United States credit card debt has surpassed $1.13 trillion, setting a new record. Furthermore, demonstrates that this is a personal decision as much as a financial one. The alarming data surrounding our credit card debt epidemic reveal a lot about how our society views personal money. Each dollar contributes a thread to the intricate network of borrowed tension that is the average American household's almost $7,932 in credit card debt. Even worse, over 25% of Americans who are in debt are paying less each month to reduce their loads. Debt holders assume they paid approximately $363 a month this year, which is little less than the $430 they paid each month in 2023. One explanation for the decline in contributions. The reason behind this is the combination of historically high credit card interest rates and rising costs for necessities. Chief credit analyst at LendingTree, Matt Schultz, according to him, the fact that people are still having trouble making ends meet after years of dealing with persistent inflation and other financial difficulties is telling. Less money is available for people to contribute to their financial objectives, such as debt repayment. However, making modest short-term payments on your credit card debt may have long-term effects that are significant. This is due to the fact that interest charges will keep coming up if you don't pay off your payment in full, adding to your outstanding balance and increasing your debt load while also negatively affecting your credit score. More significantly, Schultz emphasizes paying more for interest charges implies that funds aren't being allocated to increasing your emergency or retirement savings. The average credit card interest rate currently stands at an astounding 21%. Young adults and middle-aged Americans struggle the most as a result of the cost of basic needs reaching all-time highs, causing millions of people to find themselves unable to pay off their amounts each month. They've had less time and money to save for retirement and other goals, and now they see how the state of the economy is affecting their spending plans. That's what happened to Dan Brewerton, a 54-year-old IT worker in New York, whose finances were negatively impacted by a divorce which led to his filing for bankruptcy. In an interview with Newsweek, Brewerton cautioned people about the several drawbacks of bankruptcy, which frequently seems like a relief at first. It seems like an escape at first, but I've discovered that it can also be a trap. You are not permitted to work longer than a 40-hour work week, he stated. Any excess income is garnished and forwarded to the trustee in bankruptcy for distribution. Although Brewerton thinks people should be able to work part-time to augment their income after filing for Chapter 13 bankruptcy, that is not currently possible. Assume you make, say, $4,000 a month after taxes. In addition to paying the trustee more than 1/3 of a monthly salary, I also have to pay an additional $1,000 in alimony, he went on. So between those two figures, all you've got is a very small amount of money. After paying for necessities, almost all remaining funds are allocated to petrol, groceries, and bills. The IT worker's ex-wife's expectations of his lifestyle led him to file for bankruptcy. In order to maintain the lifestyle Brewerton described, you ultimately had to borrow money from high-rate loan providers. Ultimately, you find yourself unable to repay a mountain of debt. The person I was married to merely refused to work and demanded the best life could offer. Brewerton may be an exception, But the rise in individual bankruptcies in the U.S. indicates that his situation is not. Brewerton believes stimulus funds were the first of many variables that contributed to the increase in bankruptcies. He made it clear that the stimulus packages were not freebies. We are paying back a high-interest debt with high interest rates. Brewerton noted that while inflation and rising credit card and student loan debt are factors, this reality has been developing for decades. According to economist and lawyer Scott L. Smith, the rise in bank issues is indicative of a weakening economy. According to Smith, the rise in bankruptcy filings that we are currently witnessing is a result of past instances of severe inflation and economic unrest. People were having difficulty responding as their oxygen supply was gradually cut off. Their alternatives eventually ran out. Currently, almost 60% of Americans report that they are living paycheck to paycheck. This indicates that the majority of American workers are just one job loss away from retirement, per a survey by Lending Club from experiencing severe financial hardship. It doesn't feel like our economy is going back on track, despite the claims that inflation is declining in both. The government would like us to think that our economy is doing well right now, but it is not. The founder of the organization that provides financial education, Patrick de Césaire, told Newsweek that although the stock market bubble is still expanding, the fact that so many people are struggling to make ends meet is far more striking. For many people, increased personal debt is the result of higher living expenses, stagnating wages, and unforeseen bills. However, this circumstance entails more than just a single financial hardship. It stands for millions of people having to put off important life decisions, whole families facing financial instability, and a general air of unease that has all too often pervaded the American story. Ultimately, the credit crisis and the increase in bankruptcies revealed our economy's vulnerability and how hard it has gotten for the typical American to make ends meet while living in their own country. How does this impact you? I would be interested in reading your comments on this video. Please subscribe and thank you very much for watching.